Welcome to the Oracle by Polymarket, where we bring you news and analysis from the world's largest prediction market. My name is Will Ward. I'm the editor of the Oracle, and today we're publishing our very first podcast, which is a conversation recorded Friday with Jim Bianco covering all things macro. We talk about when Jim thinks the Fed's rate cutting cycle might end, what Trump's tariffs could realistically look like, the odds for U.S. bank failure in the coming months, and Jim's contrarian take on what he expects Powell to say at the FOMC press conference this week. But before we get started, I need to bring you this very important message that nothing in the Oracle is financial, investment, legal, or any other type of professional advice. Views expressed by guests do not necessarily reflect the views of Polymarket, and all content is for informational purposes only and not meant to be an endorsement of any type of activity or any particular market or product. Terms of service on Polymarket.com prohibit U.S. persons and persons from certain other jurisdictions from using Polymarket to trade, although data and information is viewable globally. And with that, here's my conversation with Jim Bianco. Welcome to the Oracle by Polymarket podcast. My name is Will Ward, and today I'm thrilled to be with Jim Bianco, President and CEO of Bianco Research. You've probably seen him all over CNBC or all the other fantastic macro podcasts. Jim, thanks for joining us today.
Yeah, thanks for having me. I'm looking forward to the conversation.
So we're going to get into all of the macro stuff, but first I've got to ask you, I'm getting DMs from friends who have just made life-changing money on the Hyperliquid airdrop. We've got Pudgy Penguins NFT project from last cycle announced their airdrop last night. That is going to be a big one. And I know you're not Raoul Paul, but since you are a macro guy, I've got to ask you, are we in the banana zone right now?
Oh, I think we are in the banana zone, but that's okay because there's been other banana zones in the past, and and the market kind of blows off on the upside, and it humbles everybody, and then it kind of resets and it starts to move forward. So it's the nature of the crypto markets itself right now.
I was listening in preparation for this show to an episode of you on Bankless about 4 months ago, and they were asking you, how come all the AI stocks are blowing up, but our ETH is still lagging? Like, would you say we're pretty much caught up now, or where would you say crypto is in relation to the tech stocks?
Yeah, it has been an interesting one because typically the typical crypto rally is usually led by non-Bitcoin, usually ETH or some of the other tokens will power ahead. I'm thinking like DeFi Summer in 2020 and the like, where you saw a lot of those, or the layer twos that had their moment, soon thereafter. This one has been led by Bitcoin, and it's been led by this, I think, this adoption cycle that we've seen in Bitcoin. I've quibbled a little bit about the adoption cycle, meaning that I think a lot of the flows that you're seeing into the ETFs are people that used to hold coins, say on Coinbase or in a cold storage wallet, and they've now moved into their TradFi account. And they would rather punt with the BlackRock ETF than the punt with the coins. So it's not necessarily as much new money. It shows up as new money because it wasn't in the TradFi system, but it was a coin that was held on chain, and then it moved into the TradFi system as well. And that's where I think explains why Bitcoin has kind of led this rally. But I think that ultimately there will have to be some kind of a broadening out of the rally, because I've been of the argument that what you need in the crypto rally to really have some legs is you need more than a store of wealth. You need more than just, we got Bitcoin, it's a store of wealth, it'll protect you against all the bad things in life, and that's all we need. No, we need actually to develop out a more alternative financial system. We need more trading venues, we need more lending and borrowing venues, we need more insurance, we need more prediction markets. We need to develop this stuff out and have it be able to reach more people. And I think that's what will keep. We'll go to the banana zone, we'll back off, and then it will be that development that will continue to power us forward.
Yesterday, just David Sachs was announced to be Trump's crypto and AI czar, and he's well-known investor in Solana, which is one of the big DeFi rivals to Ethereum now. So do you see the Trump administration basically just opening up some of these more DeFi use cases for crypto as it goes forward?
I think so. I mean, you've got Paul Atkins is going to SEC. Hopefully, we're going to get past all of this, SEC blocking, because remember with the SEC, they were trying to they make the case that Bitcoin proof of work was not a security, but ETH proof of stake was a security, trying to get in, mucking everything up. Hopefully, we'll get clarity on that. Sachs gets it. Sachs understands that not only AI and the potential pitfalls of AI, but with crypto as well, and that they will allow that level of development to move forward. Gone are the days of what, 2 years ago, when we were jailing developers or threatening to jail developers because they were putting together things that the government disapproved of. Hopefully, we'll get beyond that and we could see more development and see more ideas come out of this space.
Okay, so what I would like to do is start with the stuff that is totally in your wheelhouse, the macro econ stuff. We had a big jobs report today, which was on Polymarket, and there were 227,000 jobs added. That was it was in the middle of the economic forecast, but maybe a bit to the lower side. What's your reaction to the number that came out today?
Yeah, the traditional Wall Street estimate was 220,000 and it came in at 227. So that number was a little bit above expectations. But as you mentioned, looking at the poly range, it was in the range. But I think what happened with the November number was it is October. The revisions to October actually dominated, and this is rare. Just so everybody understands, the payroll report is calculated by a survey of 60,000 businesses. And the BLS, the Bureau of Labor Statistics, tries to get somewhere between about 95 to 98% of the businesses to respond to the survey every month. Well, they don't always get them all in the first pass. And then in the next month, they go back and pick everybody up from the previous month. And they do that for 3 consecutive months. So they'll go all the way back to the September report, the October report, and the November report. In October, the number of respondents was 47% in the first pass in the survey. That was a 33-year low. Now, the reason it was low was that was right after the Hurricane Milton hit and the hurricanes hit Florida and North Carolina. And a lot of businesses were offline. A lot of people were offline. So a lot of those businesses just didn't respond to the survey. Well, they pushed back and they got those people to respond to the survey again. And so the October revision was released and it went from 12,000 jobs. Remember, we reported 227,000 in November. And then they only added 25,000 jobs to it. It went to 37,000 jobs. And I think that's really what drove the response in the market was, how come October didn't get revised much higher? It's a rare instance when we're more worried about the revision than the actual monthly release. But the reason is because we had that hurricane that kind of messed up the survey response in October. Now, going forward, unless we have another weather incident, it probably shouldn't be the case. So if you add the two together, I think that it probably came in a little bit less than what people were thinking. 220 was not necessarily less than they were thinking, but they were probably thinking, some people were talking about 100, 150,000 jobs added back in October on those revisions, but it only turned out to be 25,000.
All right, so let's move to inflation. That number on Polymarket, which I've got pulled up here, has been fairly steady. The highest bracket that is being predicted now is 53% for a 2.7 annualized rate. I know you've been a bit of a hawk or sort of expressing more concern about inflation being persistent and staying above the Fed's 2% target. How do you, would you be a buyer or seller of the odds here? Like, do you feel that it's going to come in hotter than that?
Yeah, as far as two things for the November contract that you're looking at right now, I'd probably be a buyer of the higher numbers, and for a very simple reason. The data that we get with inflation is seasonally adjusted. So there is a raw, not seasonally adjusted index, and then there's a multiplier that they give you, a seasonally adjusted multiplier to get the seasonally adjusted number. If you look at the seasonal adjustment throughout the year, it's a U shape, right? So it adds to the inflation numbers at the beginning, January and February and November and December, right around the turn of the year. And then in like June and July, it subtracts from it. So it's kind of U-shaped during the year. If you look at the typical inflation report, seasonally adjusted inflation report, it also tends to be U-shaped. That during the year, the lowest part of the inflation report is in the middle of the year. And at the end of the year, when you have those seasonal adjustments, it goes up. Now, economists, statisticians refer to this as residual seasonality, meaning it shouldn't be that way. You know, your typical year should not track your seasonal adjustment. Your seasonal adjustment is supposed to remove that. So there might be some residual seasonality in the inflation data, meaning that since we're now going to be looking next week for the November inflation report, we're probably going to see that residual push. And that's why I would probably lean a little bit more towards the over on some of the, or the higher numbers on some of these inflation numbers for November.
But how do you feel in general? I think the last few months have all been 2.4, 2.5, 2.6, all like fairly steady if you average them above that 2% target. I guess like the case for being in this big cutting cycle is that inflation is kind of doing a soft landing back towards 2%. But if you look at the last few months together, it doesn't seem like it's going down. It may even be ticking upward. Or is that U-shape effect that you're talking about?
Yeah, I think, you know, bigger picture, when you start looking at the inflation rate, you're right. The Fed has a target of 2%. The Fed has stated that inflation is on a glide path, or last mile, as they refer to it, to get to 2%. Now, there's two problems with that. If you look at core inflation, where you take out food and energy, and the reason you take those out, I know people, well, you got to eat and you got to, you got to drive, yes, but food and energy prices can go up and down unrelated to general inflation or monetary policy. That's why you want to remove those. Those levels have bottomed above 3% and are showing signs that they've bottomed on a core level, and that they might be starting back up as well, or at least holding well above that 2% target. And on top of that, the Fed cannot get the inflation rate, the old headline inflation rate, back down to 2%, despite the fact that gasoline prices, oil is down, gasoline prices are approaching the lows of the year. They're about to break below 3%, or $3, excuse me, nationally. It's like the AAA's got it at like 307 a gallon right now is the national average, which is about the lowest it's been all year. You've also got a lot of weakness coming out of Europe. The German economy is not doing very well. The Japanese economy is not doing very well. The Chinese economy is not doing very well. That should be a depressant to inflation. And the argument I would give you from a bigger picture standpoint is everything's working, but yet you still can't get the core number under 3, and you can't get the headline number with weak gasoline prices back to 2. And now they're starting to look like the residual seasonality and some of the other data. It looks like this might be the best shot we've had, and that we're going to go kind of sideways to maybe start drifting higher. And so that's where I think the concern comes, at least from a mechanical standpoint, with inflation. The last thing I'll throw in there too is that the Fed has been cutting rates. As you pointed out, they think that inflation is going to be a non-issue. As they've been cutting rates, long-term interest rates have been heading higher. The day before the Fed cut rates in September, the 10-year yield was at 360. Today, as we're talking, it's around 415, and it's been as high as 450 just a couple of weeks ago. So it has been drifting higher as the Fed has been cutting. We haven't seen this in at least 40 years, that the Fed cuts rates and long-term rates go up. Why are they going up? I think it's a rejection of the policy. The economy has been at a headline level. The economy has been very strong. Inflation's been a little sticky. Trump won. That means tax cuts. That means deregulation. That means potentially tariffs, which are inflationary, as well too. And that the market is saying, you know what? We don't need any monetary stimulus. We've got a good economy, at least at the headline level. We got Trump coming in with lots of stimulus. We don't need the extra stimulus from the Fed. In fact, we're worried that extra stimulus is going to produce more inflation, which is why as the Fed makes more noise about cutting rates, interest rates have been rising since September, not falling since September.
All right, so moving on, we have this market for the Fed decision in December. You can see this morning after presumably after the job numbers came out, the odds for a quarter point rate cut shot up to 86%. If you look on the CME group, it's slightly higher at 88.8%. Do you buy that this is a reaction to the jobs number, or what do you see? What do you see that's behind this move here?
No, I think it's a total reaction to the job number because the two big statistics of the month that seem to drive policy are the jobs number and the CPI number, which is out next Wednesday. And like I said, the jobs number, I think in its totality was not as strong as everybody thought. It wasn't a weak number per se, but it wasn't strong enough to dissuade the Fed, which is why their preconception was we're going to cut rates. This number wasn't strong enough to change that opinion. Now, maybe if I was right with what we talked about earlier, we get an over on the November report and the inflation numbers are problematic. That can change next week. And then we'll be stuck. The Fed creates these problems on their own. I should say, before I go any further, I should say this because I'm always accused of it. I like Jay Powell. If it was up to me, I would reappoint him. But I'm not the president. Donald Trump is, and he has a different view of him. So I want to say that up front because as we talk about this stuff, I'll probably crap on Jay more and more. But remember, I do like him and I would reappoint him. But I think it's more illustrative to talk about some of the problems that the Fed has instead of just saying he's a great guy. And I agree with him that the Dead is the greatest band that's ever lived and all that other stuff. But so now that as far as the Fed goes, and as far as Jay Powell goes, the Fed is also, we're talking the day of the payroll report. This is the 2 Fridays before the Fed meeting on the 18th. They're going to go into their quiet period. There will be no public Fed communication. So there'll be no Fed speeches next week or Monday or Tuesday of the following week, and Wednesday will be the press conference and the Fed meeting. The problem is if we were to get a strong inflation number and that number were to pull that probability of that 86% chance that the Fed moves 25 basis points to more like 50%, what happens then at that point? Well, the way the Fed seems to operate is when they want to communicate something to the public and they can't, they call Nick Timiraos, the Fed reporter at the Wall Street Journal. He's headquartered in Washington. And I like to joke from the movie Wall Street, Nick Timiraos' phone rings with a number that says unknown caller, and he hears Blue Horseshoe likes 25. And therefore he writes the story that the Fed's going to move this, or the Fed's going to move that, and everybody reads him and thinks that's the policy. Well, if we get a strong inflation report, then we're going to be back on Timiraos watch next week. Now, in fairness to Timiraos, he didn't do this to himself. I think the Fed did this to him because they put themselves into this box with the policy that they have, that data comes out, the market is unsure, the Fed wants to try and guide the market, but Powell just can't come out and give a press conference because they got these rules about quiet periods, which I don't think are necessary. So then they basically, whisper it in Timiraos' ear and they give him outsized power. So that's something else to keep in mind too. So if we get a strong November inflation report that knocks down that 86, 88% chance the Fed's going to cut rates, then will be on Timiraos watch. Otherwise, if the numbers in line were weaker than we expect, then it's a done deal probably that the Fed will move 25 basis points.
Where would you put that sort of line of uncertainty? Like, the market likes to see it in the 75% plus confidence, or is it between 40 and 60, or what would you say there?
I usually put it at 1/3, 2/3, 33.66. So, if it's below 66, or, conversely, if no change is, somewhere around 33%, that would be the uncertainty zone. By the way, I think if I'm reading your chart right, that's pretty much where we were like 1 minute before the payroll report today. That we were right around 33.66 between a 25 basis point move and no change. So the market was kind of flirting just around that, uncertainty range, and a strong number could have easily pushed us down into that uncertainty range in a big way. It wasn't strong enough. That's why we're at 86%. But like I said, we've got the CPI report coming next week. That could, the final chapter hasn't been written on that yet.
And I'm jumping now to the January decision. So there's a January 31st, looks like the next Fed meeting. And right now that is trading on Polymarket 61% no change, 29% for another quarter point cut. Would you agree with those odds, or do you think it's basically contingent on what happens next week?
No, I'd agree with those odds. I mean, what I'm looking at, what the market is telling me here is two things. Number one, above 50% chance that the Fed will hold in January. I think that given what we know now, I think that that's right. If the data comes in weaker or stronger, that can change. If Powell makes some noises at his press conference on the 18th about, whether or not they're going to move or not move, that could change as well too. But I do think that the thinking on Wall Street and the way the data has been shaping up. Powell spoke earlier this week at the New York Times Deal Book Summit, and he did say that they had a certain set of assumptions in September when they cut interest rates 50 basis points to start about the economy. And he said that today the economy's stronger than those assumptions. It's doing better than they thought it was going to do. So it would make sense that if they do cut in December, they're going to hold in January. And I might add, just looking bigger picture, I've been one who's been arguing inflation's a little stickier. The economy's doing well. We don't need the stimulus. I've actually been arguing that if this plays out like we're looking at a December cut, a hold in January, that there's a real possibility that the entire cutting cycle ends on December 18th, that they hold in January, then the next meeting is in March, and they never really get another reason to restart because the data just doesn't really cooperate. So we could be, we'll have to see what the data says, but don't be surprised that we could be within 2 weeks of this rate cutting cycle ending.
Okay, here's one. I haven't heard you talk so much about bank failures, but I think this is an interesting place where Polymarket has some markets that can tell you a bit about the financial system that go beyond sort of like the stock prices of individual banks. So we have this market for, will there be a US bank failure by March? And that's trading at a 26% chance. Now, I didn't look up, what is the base rate, how many banks on average fail per year. But I think if I'm putting this all together, what you've been saying is like the employment is seeming fairly okay, not horrible, maybe a little bit below what economists want to see it at. Inflation is running a little bit hot, but there's still, there's the story about commercial real estate. There are all these people that have taken out huge debt to lever up on real estate or other assets that have been crushed by the higher interest rate environment. And that could be, people have talked about potential problems in that area that would take down some banks. How do you see that kind of playing into the rate cutting? Is that risk what is sort of pushing Powell to be more aggressive than maybe you cutting?
Yeah, so let's put some numbers and some stats on this. There's about 4,000 banks in the United States, and I mean some of them are very small community banks with one branch, but they still count as one, and J.P. Morgan counts as one as well. After Dodd-Frank was passed in 2009, that was the big re-regulation of the financial services industry, named after Chris Dodd and Barney Frank, the senator and the congressman who pushed that bill. There has not been one new bank charter added in the United States in 14 years. So we're just using the existing banks. They're heavily regulated. And so therefore, it's really hard for a bank to fail. And the reason I say it's hard for a bank to fail, why this is at 25%, it doesn't mean that there aren't troubled banks. There are. But what will typically happen is, because they're heavily regulated, the regulators will see that Bank X is in trouble. On Friday afternoon, at the close of business, they will close Bank X. They will call a larger bank and they will force a merger over the weekend with them, and they will reopen the next day under the new bank's name. And that's why you don't technically get a bank failure, but effectively that's what's happened, that they've been forced into the hands of a Truist or a US Bank, or if they're large enough, a JP Morgan, or something like that. So 25% makes sense to me. What caused a run of bank failures back in March of 2023, headlined by Silicon Valley Bank failing, was you had a giant rise of interest rates throughout 22 and 23, hundreds of basis points. And the banks were sitting on billions and billions of dollars of unrealized losses because of the Dodd-Frank bill, not to get too technical about it, but we decided that the financial crisis in 2008, and this is true, was caused by banks having credit risk, that they lent a bunch of money to people that couldn't pay them back. So we regulated so that they can't do that as much, hand out money to people who can't pay them back. Well, a bank has to make a profit somewhere by taking a risk. Where have they been taking the risk for the last 15 years? Has been with interest rates, betting that interest rates would not go up. Well, that worked great until 21 and 22 when inflation went to 9% and the Fed raised the funds rate from 0 to 5%. So all the bonds that they held gave them huge losses. And that's why we had that rush of bank failures. My guess is that if this number is going to move off 25%, you're going to need either a big rise in interest rates or some instability in the economy to make people think that one of these banks will fail so fast that even though they're being watched heavily by the regulators, they can't move fast enough to force a merger before they go down. So the 25% number makes sense to me.
Yeah, I'm just going into the rules of the market. So it goes by the FDIC keeps a failed bank list, and it looks like in 24, there were two banks to fail, which seemed like two kind of very micro banks. The First National Bank of Lindsay in Oklahoma and Republic First Bank in Philadelphia. And then
You can see on your list there's an acquiring institution on there too, which means who they forced them in their hands into. And you're right. So we've had two in 24. We had that rush of banks there in March, all the way to First Republic Bank in San Francisco. Those were Silicon Valley Bank, First Republic Bank, Signature Bank were fairly large banks. I think all three of them were in the top 25 of the 4,000 banks in the United States, and they all failed in fairly short order, one right after the other.
All right, so now for something completely different. This is probably one of my favorite markets on Polymarket are what we call mention markets. So these are markets that cover a speech or a live event of some sort. During the presidential campaign, we had a ton of them on Biden and Trump and Harris speeches, debates, things like that. And now they're back, but we have a mention market for what Powell is going to say during his press conference on December 18th. So this is what we've been talking about. Is it going to be 0 or a quarter of a point? So I thought maybe we could go through these and just play a little game of overvalued, undervalued, or see what some of these numbers can tell us about what is on Powell's mind and where you think things might be going. How's that sound?
Sounds great. And just a quick question. This is like, basically trying to figure out what the future word cloud is going to be for the Fed meeting, or for the presser and what Powell says. And those word clouds are always important because they give you a lot of ideas as to what was important. And so this is kind of telling us, what do people think will be important going into this meeting?
So the first one that we look at is, there's some words that will pay off. The bet will pay off if he mentions it one time, and then there are others that he has to hit it, a certain number of times. So the biggest one on here is inflation. So right now, Powell mentions inflation 40 or more times is trading at 80%, and inflation 50 or more times is trading at 53%. So I don't know if there's much of a headline here, but it just kind of confirms Powell's obsession or this is his kind of like number one priority for how he's thinking about interest rates.
So, I'll throw in one other one that's right underneath it, growth, the word growth 10 plus times. I would argue that I'd probably buy growth and sell inflation. I don't think that, based on what I've heard him say, the reason the Fed is cutting is not because they've been crowing as much about inflation being down. Again, we're talking about 40 or 50 mentions here, not one. It's been because they've been concerned about growth and they've been concerned about employment. So I would probably take that inflation 40, inflation 50, sell those. You've got growth 10 plus times and you've got unemployment 5 plus times. I'd probably buy those because I think that that's more of what he wants to talk about is the situation with growth and the situation with unemployment. Then he wants to talk about inflation. Again, remember, the hurdle on inflation is 40 or 50. And we're talking about 5 or 10, 5 on unemployment and 10 on growth.
Okay, so what my sort of reading of Powell so far has been the we're hiking interest rates, we're obsessed with inflation, it's still not going down, it's still not going down. But now the narrative that he's trying to push in this cutting cycle is forget about inflation, we need to be concerned about growth and unemployment. So you would basically flip that on its head.
Right, right. I mean, again, he will mention inflation. I mean, I'm not saying it will be zero. I'm just saying I don't know if it'll rise to 40 times because I think he will say, look, we've already established that we, the Fed, believe inflation is on a path to 2%. But what we want to emphasize because they're going to cut rates, assuming the inflation report on next week doesn't change it, but assuming they cut rates, they're going to want to drive home a reason why they cut rates. So they're going to want to talk about the unemployment rate and they're going to want to talk about growth more as a justification for cutting rates. And that's why I think getting over their hurdles of 5 mentions of unemployment and 10 mentions of growth is a better trade than having him mention inflation 50 times, especially because you're talking about markets that are trading at 53% on inflation 50 times, and you're talking about growth, at 49% or unemployment, So I think that those markets, that's the way that I think that this will play out. I would take the over on growth and the over on unemployment and the under on inflation.
All right. The second theme that I'm seeing here is Trump and sort of the relationship between Powell and Trump. So during the presidential campaign, you had Trump, I guess, accusing Powell of doing the bigger interest rate cut to sort of juice the economy to help the Democrats, or you had sort of tensions between the two sides during the campaign, and now you've had, I'm not sure exactly what, but Trump's threatening to get rid of Powell and Powell saying, no, I'm going to stay. So right now on this market, we have a 26% chance that Powell mentions Trump at all. So it's saying that he's going to try to, sweep this under the rug, not likely to talk about that relationship. But use that as a jumping off point. Like, how do you see the relationship between the two, and how do you see that unfolding in the first 100 days of Trump?
So you got to, let's bear in mind that under Trump 1, he was the guy that originally appointed Powell. And their relationship has been strained ever since. If you want me to be blunt, why is their relationship strained? When it came time to appoint a Federal Reserve chairman, because Trump didn't want to keep Yellen, he turned to Steve Mnuchin, who was his Treasury secretary at the time. And he said, Steve, we need a Federal Reserve chairman. And Steve said, I know a guy who used to work at Carlyle. His name is Jay Powell. And Trump said, okay, fine, whatever. Well, let's take this guy. And then he becomes Fed chairman. And then let's remember Trump's history. Trump is a real estate guy. Trump then becomes aware around 2017, 2018 that they got negative interest rates in Europe. And he thinks this is the greatest thing ever. You mean I can borrow money, build a casino, and the bank will pay me interest every month? I could build 100 casinos. Jay, we have that wonderful thing, negative interest rates in this country too. And of course, Jay Powell wasn't having anything to do with negative interest rates. So Trump got mad at him. And he started, yelling at him that he wanted interest rates down below zero. And that's where all of the strain came between Trump and Powell. And Trump originally in 2018, 2019 was making noise that he could fire Powell back then too. So this is hardly new. So now he's revived that scenario where he's going to fire him. I don't think he's going to fire him. And the reason I don't think he's going to fire him is because he would have if he would have in 2019, as opposed to now. I think Powell serves a better for Trump to be a punching bag where he is basically going to, leave him in place and just tweet at him or on Truth Social at him that he's a mean, terrible guy, ruining everything. And he can't wait until his term is up and get rid of him as well. Now that I've said that, Paul would love to mention Trump's name 0 times. Paul would love to mention tariffs 0 times. But the media, the press reporters that are there can't help themselves. They're going to constantly ask him, are you going to get fired? What do you think of Trump? What do you think about tariffs? How do tariffs work in the monetary policy? And Paul has answered this question exactly the same way 50 times, right? We have no opinion about tariffs. That's something Congress does. We just deal with whatever they decide to do. I don't think he can fire me. Trump thinks he can. If Trump wants to pull the trigger and try to fire him, that's why we created the Supreme Court. They could make the determination as to whether or not the president has the power under the Federal Reserve Act to fire the chairman. But so I think that Powell doesn't want to talk about this and will try not to say his name and will try not to mention tariffs, but might be just forced into it because he's going to get a lot of questions on that topic. So I think that those markets are probably appropriately priced.
Just to give people a number, right now Tariff is trading for a single mention at 56%. So while we're on tariffs, let's talk about that a little more. So obviously Powell does not want to touch it, but Trump has made tariffs the centerpiece of his economic policy. We have a market that I can pull up on a different screen, but it's like, large tariffs first 100 days, something in like the mid 70%. So fairly likely for Trump to push up the tariffs even more, which he put in place, which Biden kept most of those tariffs. So he's, jacking them up even further. So I know Powell doesn't want to talk about it, but how do you see tariffs playing into the inflation picture? Like the goal is to reinvigorate U.S. manufacturing, but that's going to take years or decades. So in the short term, what do tariffs look at for inflation?
That's a really good question because you get a wide range of answers on this. And I'll give you my take on it and try and explain it. Trump's first book he wrote over 30 years ago was The Art of the Deal. His second book, after he ran into trouble in the real estate crisis in 1990, was called The Art of the Comeback. And in those books, he talked about negotiating ploys and that whenever you negotiate with somebody, you need a credible threat. The credible threat could be, I will walk away from the table and we will never do a deal, and you need to have a deal with me. In this case, his credible threat is tariffs. That I need China, I need Mexico, I need Canada, I need Europe to do certain things, and I will threaten to punish them via tariffs. And that's why I thought that if you remember last week, Trump put out a Truth Social that he said, Mexico and China, Mexico and Canada, if you don't stop the inflow of illegal migrants and drugs like fentanyl, I'm going to slap tariffs on you to make your head swim. Well, he said it in this Truth Social. It's a gambit. I need you to do certain things. Stop the illegal immigration, stop the flow of drugs. You won't get tariffs. So I think the tariffs are a gambit. He talks about putting 100% tariffs on Mexican cars. Chinese manufacturers are building plants in Mexico to assemble cars, put them on a rail and ship them to the United States to sell them. Trump says, I'm going to put 100% tariff on them. Or is Trump going to threaten 100% tariff and he's going to come out and say that those Mexican car manufacturers agreed to take mufflers from somebody in Tennessee and take gas tanks from somebody in Oklahoma and take chassis from somebody, in New Jersey or fill in the blank, South Carolina, and that the majority of the car will be parts or components coming from the United States. So therefore, there'll be very little or no tariffs. That's where I think his thinking is. Scott Bessent, his Treasury Secretary designate, thinks that that's the way that they're going to use tariffs. Others think, no, he wants the revenue of tariffs. He wants to stick tariffs on everything else. So really the question is, do you think tariffs are a gambit to get an outcome, a deal? Remember, this guy wrote Art of the Deal. Or do you think that he thinks of them as a source of revenue because he's made the noise in a 60 Minutes interview, or no, it wasn't 60 Minutes, but somewhere he made a noise that maybe if we do enough tariffs, we could get rid of the income tax. That's not that outrageous because we funded the United States government throughout the entire 19th century on only tariffs and no income tax. But of course, the government was much smaller than it is right now. If you believe that that's his thinking, then yeah, you're going to get tariffs till your head swims. But if you think like I tend to think it's a gambit, then maybe what we're going to get is a lot of deal announcements with a lot less tariffs. But we'll find out. But I would probably be betting that the under on imposing large tariffs or on the volume of tariffs, because I think we're going to get more announcements of deals and less actual tariffs.
Okay, and I think I may have misstated earlier, just from memory, but I'm looking at the tariff markets here. So we've got several different ones. You've got the Trump 25% tariff on Mexico and Canada in the first 100 days. That's at 19%. 40% tariff on China in first 100 days, 12%. And large tariffs, I think that's like 5% or something in the first 6 months. That's the highest at 37%. So yeah, this does seem to back your thesis that generally, especially these larger end of the tariffs, are more on the negotiating ploy rather than this is going to happen.
Right. And bear in mind that in fairness, we really don't know what he's thinking. That's kind of so I'm in that line too, probably with the 19, 12, and 37% numbers. But, if you have a different opinion that no, he's more into the revenue side of it. Remember, he said his favorite word in the dictionary is tariff during the campaign. Then there's a lot of juice to be made by going along those contracts.
Just to go to the theory on tariffs, what if there was one of these big tariffs, what does that do to inflation?
Yeah, it raises inflation, but keep in mind the following. If you look at the CPI basket, that is what the government thinks we spend our money on, and it's not that inaccurate. The average basket has about 75% services and about 25% goods. So right there, services, a plumber is the ultimate example of a service. You're not getting a Mexican or Canadian or Chinese plumber to come to your house. You're getting another American to come to your house or somebody who lives in this country. If you're talking about a landscaper who might be an undocumented migrant, but at least they live here to do the services work for you. So first of all, so 3/4 of the things we spend on tariffs are not directly impacted by them. It's the 1/4 of goods, and of those goods, most of those goods are probably imported from outside the country. So if you were to slap something like a 50% tariff on those 25% of goods, that would raise the inflation rate by about 1 to 1.5%. So that's a big deal, but and it would not be taken well by the financial markets. But the reason I say that is people somehow have these outlandish claims that if tariffs are going to lead to 5 or 10% inflation. No, because most of what we spend our money on is services. And sure, the plumber might use parts that come from China, and those parts might become more expensive, but you're really paying him for his labor and his expertise. You're not paying him because he's bringing a valve to your house, even though that valve might be a little bit more expensive because it came from China. So yeah, it would have an impact on the market. And yes, a 1% rise of inflation would have a dramatic impact on interest rates. It could push the 10-year yield well above 5%, maybe closer to 6%. But it wouldn't be as catastrophic as a lot of people have trying to make this out to be.
All right, so I want to turn to another market. This market is not on the Powell mentions, but there's a there's a Trump deportation executive order in the first 100 days, trading at 91%. So market is saying highly likely that there's this, deportation, which is one of Trump's big claims. You just said that most of the inflation is coming in services, and we're looking at a situation where the market is saying it's highly likely that there's going to be some deportations. There's not a market for how many, but how do you see that, right? Like there's this, people are coming into the country, that number has gone up. I think no one is really disputing that. Trump is looking to put people out. Is that inflationary, deflationary? How would that affect the macro?
I would argue it's probably a push. And the reason I say a push that it won't really impact the macro as much is Tom Homan, his border czar, has made it clear that their priority is national security risks and criminal risks. So they want to go and they want to find anybody who's on a terror watch list or somebody that could be a national security risk, or they want to find those Venezuelan gangs that have taken over apartments in Denver and the like, and they want to get rid of those risks. That's who they're going to go after first. That is their priority. I'll take them at their word. If that's who you're going to start to deport, they're not working. You're not paying them to mow your lawn. You're not paying them to clean your house. So I don't think that that would be a big drag on the economy. If, on the other hand, they want to get numbers, we need numbers. How do we get numbers? I know, let's go raid the local hotel because they've probably got a lot of cleaning ladies that are probably illegals, and that would be interesting because Trump owns a bunch of hotels. And whether or not that, they could round up a lot of those people, they can go to a bunch of farms in farming states and look for crop pickers, round them up and deport them. If that's their goal, to get numbers, and that's how they go about doing it, and again, I'll mention that's what they said they're not going to do, then yeah, that could be a drag on the economy because you're taking productive workers out of the economy in a very disruptive way. So I'll go with them on the face value. If they want to get rid of national security risks, terrorists or potential terrorists, and get rid of criminals who, like I said, are probably on the dole, in the Roosevelt Hotel in New York, and are probably not working in the first place in this country. No, I don't think that's going to be a big problem. But if they expand beyond that, I think it will be a bigger problem. And for all of the hyperbolic language that the nice grandma nannies are going to get, rounded up at the playground and summarily deported from the country, I get the argument. I'll just be shocked as anybody else if they actually got down to that point, because what they would argue is that grandma nanny that's, with some kids at the playground is not a problem in this country. There are a lot of other people that are bigger problems that we're going to go after first. And they may never get down to that level before they have to go to that point.
All right. So last question on the Trump economy and picks. We've got this market for all the designees, people that Trump has said he intends to employ for various cabinet positions. On the ones that are underwater below 50%, you have Pete Hegseth 30%, Tulsi Gabbard 56%, and Kash Patel was around the 60s. He's up to 70 now. But then all the way down here, you've got Scott Bessent, who's Trump announced for the Treasury Secretary. He's trading at 95%. He's in the kind of slam dunk groups. I don't suppose you have any dirty laundry on him that you think is going to come out and tank his chances?
No, I don't think that there's much of anything that I know Scott a little bit, and I don't think that there's he's a good guy, a straight shooter, and I think it's going to be fairly straightforward. And when you look at all of these picks, it's kind of these markets. There's really only, like you said, there's about 15 markets on this list, and most of them are trading in the 90s, and it's hard to see why they would come out with something against somebody like Kristi Noem, the governor of South Carolina, is trading at 93% to be Trump's Homeland Security pick, I think is what
Yeah.
but she's already written a book talking about how she took the puppy behind the barn and shot the puppy. We already know that about her, and she's still 93%. So it's going to be hard to find something worse than that, and she's already willing to survive that as well. I do think that Hegseth is probably the one that's most in trouble, but the market reflects that at only a 32% chance that he is going to be nominated. If I had to buy or sell any one of these, as a trade this morning, the day we're recording, Trump came out with a strong endorsement on Truth Social of Hegseth,
Yep.
saying that he's a great pick, fight, Pete, fight. I'll buy him at 30%. Not because I think he's going to go all the way to 100, but because he's going to fight and put some doubt in there. Maybe he'll get back up to 50 or 60%. And then I'd sell it at that point. Unless, of course, if he got to 50 or 60 and I thought, no, he's actually going to make it all the way through at this point.
Yeah, and he was in deep trouble. He was down to just 12% 2 days ago. So that, yeah, that
Yeah, that's
30%
when
is
they
a
were,
big rally.
that's what we were talking about, that he was going to put DeSantis, the governor of Florida, in place of headsets.
DeSantis, and there was that New Yorker article that came out. Um,
Yeah.
on Bessent, last thing, like, what do you have any read on? Is he going to have any radically different Treasury policies than Yellen, or is it going to be basically like steady as you go? Don't scare the bond market. Just kind of keep selling that debt.
Yeah, I think, as far as having radically different policies, yes, but I don't think they're radical policies. Let me be blunt about this. There is a lot of talk in the bond market about the debt that we've been issuing. There is a committee called the Treasury Borrowing Auction Committee, or the TBAC. This is a bunch of Wall Streeters that advise the Treasury on what is the best way to go about issuing debt. They said that 20% of the debt that you issue should be Treasury bills, 80% should be Treasury notes and bonds. Under Yellen, for the last year and a half or so, 2 years, the percentage of Treasury bills has been higher than 20%, and the Treasury in the percentage of notes and bonds has been lower than 80%. Now, why is that? This theory is she wanted to put in less longer term yield supply to hold down longer term rates, to hold down mortgage rates, to help get help get Biden reelected. And well, you still got to issue some debt somewhere. Well, where are you issuing it? At the front end of the curve, more bills. Now, I think Bassett understands this better than just about anybody else. And I think that he's going to return us to probably a more sustainable path as well. And as far as the other policy, Bassett is the guy who's been really adamant that what Trump plans to do with tariffs is that they're a gambit, and that they are a tool that they will deploy if you don't play ball with them. But if you do play ball with them and do what they want, whether it's car parts for Mexican automakers or the flow of illegal immigrants over the border from Canada, if you do play ball with them, there won't be those type of tariffs. So I think he's a really good pick at that spot.
Let me ask you a follow-up on the long-term versus short-term debt thing, because I've heard a lot of talk about that, but I don't really understand like why it matters. So like what is the risk is there a risk to the debt markets if they're doing too much short-term, or what's the issue with that imbalance from where it
No,
should be?
the risk, it's the other way around. The risk is not that they're doing too much short term. The risk is that they could dramatically increase long-term issuance to get it back into balance. Ultimately, the Treasury has said they want to be back into that 20/80 mix, and they're above it. So in order to get it back into balance, that means you got to issue a lot more 10-year notes, a lot more 30-year notes, a lot more 7-year notes, and a lot less 6 and 3-month bills. Well, issuing more 7, 10, and 30-year and 20 years too in that mix, you run the risk of having bad auctions, having higher interest rates. And that is the concern that everybody has right now about that mix, is that they have to get that back into balance at some point or another. One of the arguments has been that the yield curve, the 3-month 10-year yield curve, has been inverted for over 2 years. Inverted means short-term interest rates, the 3-month bill, is still above the 10-year note. That ultimately that has always been a signal of a recession or of some sign of financial stress, that inverted yield curve. It's been that way for 2 years. Now you could argue, but we haven't had that much financial stress related to the yield curve in the last 2 years. The answer might be yes, but it's not good to keep the yield curve inverted for this long a period of time. That is issuing a lot more bills and a lot less bonds is exacerbating that continued in negative or inverted yield curve. and that you ultimately want to get rid of that inverted yield curve, go back to a more normal shaped curve where the longer maturities have higher yields because the longer maturities are supposed to be more risk. So that's one of the reasons why. Well, why don't we just continue it like this forever? Because the argument is, well, then you might be continuing to push this inverted yield curve, and that could be problematic.
Got it. Jim, you've been so generous with your time. I really appreciate it. I know we've gone a bit over. If you have a few more minutes, I'd love to ask you a question or two about just prediction markets in general, because I know before we were recording, you were talking about your history on some of these markets. So is that all right?
Yeah, yeah, sure.
So I know, like during the election, I was following you. You were tweeting out a lot about the odds on Polymarket for around the election, and you were a believer of the odds versus other models or things like that, or supportive of that. But since you kind of live and breathe these economic indicators, and we've gone through these, kind of like polymarket versions of the inflation indicator or the Fed rate cut market, things like that. How do you think about those as, do you see them being far off from like the larger financial markets, or do you see them being pretty much in line? Or are you kind of bullish or bearish on seeing more economic data on Polymarket?
Oh, I'm very bullish on it. I mean, what I see is yes, for some of the markets we went through, like the probability of the Fed move in December, it even you put up on the screen, that the CME trades a federal funds futures contract, and you could calculate probabilities based off of that too. And they were largely the same thing. One was 86, the other was 88. That's not a meaningful difference between the two of them. So they're useful because what I've argued prediction markets do is they distill all known information into one probability. I've likened them to the point spread in a football game. It is useful for me to know that a team is a 3-point favorite over the other team. That tells me one team's better than the other. If a team is a 14-point favorite over another one, that tells me that that team is grossly favored over the other team. And that's useful information. The mistake that I think people make with prediction markets is they say, oh, well, then if you don't win the game by 3 or 14 or whatever the point spread is, the market was wrong. Well, almost every football game never ends up exactly the same way that the point spread says it's going to end up, but it is a good indication of what we know and what we expect. And it helps us to know what the expectations are in order to make decisions. Also, during the election, we had the whole thing about the big French trader and whether or not he was manipulating the market. I've argued that that is almost a pointless conversation because I don't see. Suppose he came out and said, I bought $30 million worth of, Trump is going to win because what? He's going to say, because I'm going to force the Trump futures contracts higher, and millions of Americans are going to go, oh, okay, I guess I'll vote for Trump because it looks like the betting market says he's going to win. It doesn't change anybody's opinion. That's what I'm saying is that you can manipulate it if you want, but it's a pointless exercise, in my opinion, because you're not going to change the outcome of the election by doing it. You're just putting yourself at risk of buying a contract that is at the wrong price and losing money. So I've been a big fan of these contracts, and I think the more the merrier. They help us understand where people are thinking. They help us to understand what is discounted in markets and and they give us better guidance in making decisions.
And last question for you, if you could create your own market on Polymarket, or group of markets, or seeing a new type of indicator, what would it be? What would you like to see on the platform?
So I'm going to give you two, and they're going to be in my wheelhouse. The first one is Powell's term as Federal Reserve Chairman is up in 2026. Who will be the next Federal Reserve Chairman? Now, of course, you can have Jay Powell on that list. You could put the name that Wall Street seems to mention the most, and that is Kevin Warsh, and some other names as well. The other one I would do, which would be a little bit more nuanced, is Scott Bessent has mentioned this idea of what is called a shadow Federal Reserve Chairman. What he meant by that was, look, Trump is not going to fire Powell, but what he could do, the argument is that he wants to put Kevin Warsh in as Federal Reserve Chairman. announce him this spring, like almost a year before he needs to be take over. And then he becomes kind of the de facto Federal Reserve chairman. So every time Powell has a press conference, they'll have Kevin Warsh sitting at the studio at Bloomberg or at CNBC to basically armchair quarterback everything that Powell is saying. And then we get to the point where Powell says something and everybody looks at Kevin and says, do you agree with them or don't you agree with them? And then the market's going to say, do I follow what Powell says or do I follow what the shadow Fed chairman says? So the other market I would put is when, will Trump make a decision on the next Federal Reserve chairman? Maybe by month. Will it be March, April, May? Will it be December of next December in a year? Because I think it's January of 26 is when they've got to have them in place. So that would help a long ways to give us an idea of what people are thinking about who is going to be the next Federal Reserve chairman. I'll remind everybody that it has been argued that the Federal Reserve chairman is the second most powerful person in Washington after the president of the United States. So his position matters a great deal.
Jim Bianco, thanks so much for joining us.
Thank you.